Question 83 from Math 3022 2011. Similar question on the 6127 paper. And it says you've got a European vanilla call and put options. They're available on the same underlying stock with the same strike price of £12. So K is 12. With the same expiry after 3 months. So the expiry date is, and the key thing is now, what is the unit of time? Here we've got it in months, but you are told that the risk-free rate is 5% per annum. Okay, so R is 5 over 100 per annum. So if your risk-free rate is in years, your time has got to be measured in years. Okay, so a 3-month expiry is 1/4 of a year. Okay, so if I've given you the monthly interest rate, then you will do things in months. If I give you the annual interest rate, the time period is in years. And what have we got? We've got the call and put options are currently £3 and £6. And what's the other thing? The current price of the stock is £8. Okay, so that's all the information that we're given. Pulling that out from the text. First thing is to say, show that the put-call parity formula is violated for these options. There's technically an error in this question, in that it should really say that the underlying stock pays no dividends. Okay? Because otherwise the put-call parity formula that we derived isn't necessarily true, or won't be true. So that's an implicit assumption in the question. So we write down the put-call parity formula, Ct plus K e to minus RT minus T equals PT plus ST. So let's have a look at this. So the left-hand side, let's put the numbers in. Well, the numbers are Ct is 3, K is 12, e to the minus R over T minus T, or T minus T if you like, this is T minus T. So that's a time from now to expiry is 1/4, so it's 5 over 400. Okay? And if you work that out, it's 14.851. Actually, say it's 14.8509 if you want. Okay? The right-hand side, what's that? It's just PT plus ST. PT is 6, ST is 8, so it's 12. No, 14. Okay? So the left-hand side says that we should have 14.8509. The right-hand side says we should have 14. Therefore, put-call parity is violated. So what does that mean? That implies that there exists an arbitrage. And not surprisingly, the second part of the question is to identify that arbitrage. So, remember, if there's an arbitrage, sell expensive side, buy cheap side of the inequality. Okay? And the other thing we have to do is we have to start with nothing, show we end up with a profit greater than 0. In this case, it will be a profit, a guaranteed profit. In the strict case of arbitrage, you only have to show there's a finite probability of a profit, but there's no indeterminacy here, so except in value, final value of ST, but that ST that's unimportant for this case. Right, so which is the more expensive side? Well, clearly we've got the left-hand side, we've actually got CT plus K e to the minus RT minus T is greater than PT plus ST. So we have, so that one, so I'm going to sell that one and buy this one. Okay? Sell the most expensive side, the thing that's greater in the inequality, and buy the cheaper side. Okay, I'm not posing an opposite scenario here. I've already established that there's an inequality, so now I'm going to track down what that arbitrage is. Okay, so what do I do? If I sell this one, I've got to write CT. Okay. Selling money means I borrow money. And then the buy side is that I have to buy PT and I'm going to buy ST. Okay? So when you sell money, it means borrowing. Sell just means negative of the good thing, which means having the money, but you're borrowing. Okay, so at T equals now, what is my position when I do that? So, I'm going to write my position and put the receipts in here. So I'm going to write, without lots of generality, let's put T equals 0 here. Alright, so I write C0, and so I receive plus C0. So I'm writing a call option, someone pays me for that, and they pay me the price of £3. Okay? Because that's the current price of them here. You want, well, let's take the 0 out of it, I'll confuse you. So now I borrow this amount. Okay, which is then K e to the minus RT minus T, which is 12 times e to the minus 5 over 400, which is 11.8509. Okay? Pounds. So I'm borrowing that money. I'm assuming that the interest rates of borrowing and paying back are the same. Again, this is a massive assumption because in practice they're not, but in a no arbitrage environment, that's what you have. You only have one interest rate. So now I buy PT, and that means I've got to pay out PT. How much is PT? PT is £6. Okay, and I also buy ST, pay out ST. ST is £8. Like that. So overall, if I add all this up, what do I get? My net position is that, which, from this argument here, has got to be greater than 0, and if you work it out, it's 0.850934. 34 in here, which is then greater than 0. So that's not an arbitrage necessarily at the moment. That's just money that we've got from making that, exploiting that inequality. What we have to go through to show at expiry, we end up turning something from 0 into a positive profit, because you see what we've done here, we've written call options, we bought put options, and these aren't, if these are European put options and European call options, we can't exercise those until expiry, so we don't really know what the ultimate worth of those are going to be. So we have to worry about that at expiry. So now we've got t minus t equals a quarter, okay, or at t, we're at expiry now, okay, and then I'm going to write down liabilities and assets, okay, I'm going to write it down closer here. Right. So what are my liabilities? Okay, things that I'm going to have to pay out on are options I write and money that I owe. Okay, so at expiry, I owe minus CT, and or I've got an potential I've got to pay out an amount CT, depending on whether the option someone is going to exercise that option or not, because I've written this, and I have to pay back the debt. The debt has grown from ke to the minus rt minus t to ke to the minus rt minus t times e to the rt minus t, which is k. So my debt with interest has grown to k. Okay, but then the assets I've got are, I have the put option. It might be worthless, but I might get some money for that. And I can always sell my share at the market rate at that time, ST. So if I add up all of these, what have I got? I've got two scenarios. Now let's do the scenario first of all where ST is greater than K. When ST is greater than K, I've got a payout that I'm going to have to make on the share, on the call option. Because if ST is greater than K, the holder is going to exercise and demand ST minus K from me, or the equivalent in assets. So then I've got the minus K here. If ST is greater than K, the put option expires worthless. Okay, and then I've got ST. So if I add all that up, I get 0. What happens if ST is less than or equal to K? Well, if ST is less than or equal to K, the call option expires worthless. I've still got to pay my debt K back, but now the put option has a payoff of K minus ST. I will exercise the put option, and I will receive that amount of income. And I've still got the share I can sell at ST. And again, if you add all that up, you get 0. So that particular portfolio that I've got has 0 value, net value, at expiry, regardless of the outcome. So it's 0 value at expiry. However, I've still got, this is the non-cash bit, I've still got the cash in the bank. I've got this amount of money here, this thing here, this has grown to, this is now an asset of, well, I've got no liabilities because it's given me something in the bank, and it's grown to CT plus K e to the minus RT minus T minus PT minus ST e to the RT minus T, because it's been sitting in the bank earning interest. So this is earned interest, and if I work it out, then it's 0.850934 times e to the 5 over 400. Because RT minus T is 5% times a quarter, so it's 5 over 400. And then if you work that number out, it's 0.861637. So basically you make, for each, if this scenario existed, you would make about 86 pence from each of these trades that you did. So if this scenario existed, you could make an infinite profit. Because I start with nothing, and I've gone to 0.86 pence, or pounds. So, of course, I have to assume that I can borrow money and I can sell things and there's no problems with liquidity in that way, but I can start with nothing and finish with 86 pence. So if I could do it once, I could do it twice, and I'd make 2 lots of 86p. If I could do it twice, I could do it 3 times, and so on. So I could do it theoretically an infinite number of times, and I would make an infinite number of profit. So therein lies the problem, because there isn't theoretically you can create as much money as you need to, but in practice there's not an infinite amount of money. Okay? So therefore, if I can do it once, I can do it an infinite amount of times. So that's why in practice this arbitrage would not hold forever. Okay? As soon as you started to play around on that, people would spot that this was going on, or the market makers would spot, and they would adjust the prices here accordingly. Okay? One of those prices would be adjusted if it was just a single price to take account of that. Now in practice, you don't get single prices, you've got a bid-ask spread. And that's usually sufficient to mean that you don't have an arbitrage. So they will sell it for a different price to the amount that you could, or you would buy it for a different price to the amount that you could sell it for. Okay? And that would sort of smooth things out. But in theory, that's your arbitrage. Okay? Any questions on that? Right. Okay, another arbitrage question? No? Hands up yes? Hands up no? Hands up we couldn't care? Well, what other question do you want then? I'm going to do one more arbitrage, right? Four. Okay. Right, so you've got European vanilla options with strike price of £1. You've got a time to expiry of 3 months, so I'm going to do that in terms of years again. And they're available on an underlying asset that pays no dividends with current value ST equals £1.20. The annualized risk-free rate is 1% per annum. And I've also reiterated that it pays no dividend. The current markets of the euro call are 10p, and the euro put doesn't say. Interesting. Yeah, it says it in the next part of the question, it's 8 pence. Right. So it says, identify an arbitrage and calculate the profit per option that would be made if ST is £1.30. So ST is going to be £1.30. All right. Okay. So. Right, so we've got to identify an arbitrage. Now, the strong hint was that if I didn't tell you what the put option price was in the first part of the question, and I only tell you in the second part of the question, that it's the call option that's got the arbitrage associated with it. Okay? So we'll try an arbitrage on CT. Okay? So the first thing that we've got is ST has got to be greater than or equal to CT. Excuse me. ST has got to be greater than CT. Well, what's ST? ST is £1.20, and is that greater than or equal to 10p? Yes. So we don't. The upper bound is not violated. Okay. What about the other one? We've got the other one is that CT must be greater than or equal to ST minus KE to the minus RT minus T. So let's look at that one. CT is 0.10. ST, this is 1.20 minus 1 times e to the minus. Now it's 1% over a quarter of a year, so it's 1 over 400. Okay? Well, if you want me to do it explicitly, it's 1 times 1 quarter, 1 over 100 times 1 quarter, which then equals 0.202497. So therefore, we actually have, in this case, the right-hand side turns out to be bigger than the left-hand side. So that's not true. So we've got an arbitrage. Okay. So this tells us immediately we've got an arbitrage involving the call option. So, there are several ways in which we can go about playing around with the arbitrage. Gosh, we can rearrange this around and the inequalities will still be violated depending on where we put the results. It's always going to be violated. So one way in which we can do it, I'm going to rearrange to give us ST minus CT, which should be ST minus CT should be less than or equal to K e to the minus RT minus T. Okay, we should have, but actually we end up with ST minus CT is greater than K e to the minus RT minus T. Okay, so the rearrangement of the inequality that we should have is this form, but all that means is that the rearranging it isn't going to change the fact that the inequality is violated, so we've got to have the opposite, which is this one. You can check that for yourself. So we're going to sell the expensive and buy cheap. Okay? So what does that mean? We're going to start with nothing. Okay? I'm going to sell ST minus CT. That means I'm going to short sell ST because I'm starting with nothing, and I'm going to buy CT because if I sell minus CT it's the same as buying CT. So what do I get? I'm going to receive ST minus CT. Okay? So if I short sell it, I get ST. but if I'm buying CT, then I have to spend some money. Let me call that equal to M, an amount of money M, but I know from here M is going to be greater than K e to the minus R T minus T. So then I'm going to invest M, that amount of money that I make from the selling, I'm going to invest M in the bank at interest rate R. And that is the equivalent of buying that money. Okay, that's like putting the money in the bank. So what happens? At expiry, the money in the bank has gone to M e to the R T, or T minus T, right? Now that money, by definition, is going to be greater than K e to the minus R T minus T times e to the R T minus T, which is K. So I've got more money in the bank than K. But my position, I have to close the position so how am I going to close the position? Well, I short sold my share, so I've got to buy back the share. So if ST is greater than K, I'm going to exercise my option at CT and buy one share at K. Because if I exercise my call option, it gives me the right to buy that share at K, and then I can hand the share back. Okay, because I borrowed, I short sold, so I have to hand the share back at expiry. Okay, so if I exercise the call option, I can buy that share at K and hand the share back to the owner. Okay, you'll see where that money comes from in a minute. But if ST is less than or equal to K, then CT expires worthless. So I have to buy ST, or buy share at ST, which is less than or equal to K, or let's do it this way rather. Alright, okay, and hand it back. Hand back the share to the owner. In both cases, I've got to hand that share back. In one case, I buy it by exercising the option. In another case, I have to go to the market and buy it. Okay, so what does that give me then? Well, remember I've got K in the bank at expiry. So I can use the money in the bank here. I can use the money in the bank okay, to pay for that. And equally, I've got more than K in the bank, so the point is that M e to the RT minus T is greater than K, so I've still got a little bit left over there, and here M e to the RT minus T is still greater than K, which is greater than my ST, so I can use the money in the bank as well. So regardless of those outcomes, I can use the money in the bank to cover my exposure. Okay? But actually, if you look, what have I got? I've got more money than I need, because if ST is greater than or equal to K, what have I got to pay out? I've got to pay out K, but I've got M e to the RT minus T, which is greater than 0. Okay? Because m e to the r t minus t is certainly greater than k. If st is less than k, I have to pay minus st plus m e to the rt minus t. That's my wealth, my assets minus liabilities. And this is greater, that's certainly again greater than 0, because this is less than k, and that's greater than k. This is greater than k. So in both scenarios, I get a profit and that's the arbitrage. It's an arbitrage because I started with 0. So the question actually asks you to work out what that profit is if the share has gone up to a certain value. So let's now do that. So, what have we got? We've got basically my profit here. So I put that in. So my profit would be right, I've got ST equals £1.30. Okay? So £1.30 is greater than K. Is it? What was K? Was that £1? K was £1. So I'm in the scenario where ST is greater than K. So I'm in the scenario where ST is greater than K, so my assets, so my net worth at T equals this one here, m e to the r t minus t minus k. Now what was m? M was formerly st minus ct, the value at the time I started, times e to the rt minus t, that's minus k. So the value that it was originally, the st was £1.20, my ct was 10 pence, e to the 5 over 400, no, it's 1 over 400, isn't it? Because it's a quarter times 1%. Minus 1 for the k, and I think if you work all that out, go away. Sorry. It's asking for passwords. Right. Yeah. So that's the profit. So basically you make about a 10p profit in that arbitrage scenario. So again, because you can do that just by doing that once, you do it an infinite